10-year note yields moving a bit higher after last week's low marks. We saw the 10-year note yield really, fail to get back into that 260 to 280 range. We've talked about that first quarter range since March FOMC. We've been trading south of 260. We've seen a move, down below 240 and back. Market seems to be waiting for something to happen. Yes, we've traded significantly higher off those low yields. However, especially once we got that March minutes that came out in April, but obviously the market has seemed to have faltered as the yields got to a certain level, got to 260 and failed. Now we're back closer to 250, 255. We're still in the ballpark, but certainly not seeing any momentum. The market is missing that. Something that we had mentioned about gold kind of being in flux back and forth, different levels, not finding any real levels to draw near. And that's what we're seeing in 10 years as well. 10-year note yields right now continue to kind of waver as they wait for the it moment. We thought maybe it was going to be GDP. It wasn't. Now we have obviously FOMC coming up this week and more data. So right now, I think that those are the significance here is that we aren't seeing a momentum trade yet in 10-year notes. So right now, still hovering below that old range, waiting for the it moment. And if volatility could tell you anything, volatility, while it is not getting higher, it's hovering sideways on the 14-day moving average. It's elevated from where it probably would be in any other given scenario that we talk about ahead of an FOMC meeting that's telegraphed in the wake of what we've seen from the Fed. And I think that right now we could be seeing things start to sort of fester a little bit. You look at some of those yield curve spreads, they're starting to re-steepen. Well, a lot of that could have started with the idea that, well, we got pretty close to zero, so how much lower can we go? So you might be seeing some unwind trades there, which we've propelled some of these curves to go steeper from their flattening bias. But ultimately, I think there's a little bit of smoke in the short end. I think that's what's causing some of this. That is also what's causing volatility to not go down anymore and to hold steady. So right now we've got yields kind of a flux. We've got volatility steady. Lastly, let's look at what's going to happen at FOMC. It's likely we could get a tweak in the interest on excess reserves, something the Fed may look to do to get money pushed out the door, possibly a modestly lower mark there. But I don't think they're going to change anything when it comes to true policy or their outlook on the economy. There hasn't been enough evidence to suggest that there's something wrong. Likewise, I do think that the market right now wants to believe that the glass is half full. They want to believe that the Fed is in control. And until they're proven wrong, I think the Fed is going to try and ride that wave. So right now, ahead of May FOMC, not seeing a whole lot as far as policy changes. But again, we could see a shift in that interest on excess reserves, sort of bolster what's going on in the short end. But 10-year note yields right now remain in sort of a flux area. No momentum to speak of. We could see that after Wednesday's announcement.